Now let's discuss scaling in and out of your positions. So first of all, what is it when we are talking about scaling in and out? Scaling in refers to having additional entry orders after your first entry. And scaling out is the opposite. So after you had your entry, you are partially closing out portions of your trade. On your chart, it looks something like this. And there are many ways how we can scale in and out, as we will see. So assuming we have our breakout entry here, so this is our general first entry, the way we looked at it throughout all of the videos. For now, we have only looked at initial entries, right? So we have a resistance, then we have maybe a lower bounce, potentially we are in an uptrend, then we get in long here on the breakout. And then traders who want to scale into their trade, especially for trend following traders, if you are trying to capture long trends, remember how trends unfold in this wave rhythm, right? We have impulsive wave, corrective wave, impulsive wave, corrective wave, impulsive wave, correction, and so on. And the idea is that as a trend following trader, it is possible to add to your initial entry on further breakouts. So each time the market moves into the next impulsive wave, so we break out into a new high, you can add to your initial position, right? So your first entry here, then we have a breakout out of the correction, we execute another entry. Here we add another entry after another breakout. We have the impulsive wave, we go into the corrective wave, we wait for the market to break into a new high, and then we execute. So at the end, at this point, you have your first entry, second, third, fourth. So in the end, you'll end up with 4 entries, 4 trades essentially. And it could look something like this. We can have, for example, in Forex, we buy maybe 2 lots, and then each subsequent entry, we add another lot. And of course, there are so many ways how you can do that. You can have a very big first position and then smaller ones afterwards, or it could be a first small entry and then the next entries are either the same size or maybe even larger. And it really depends on the risk profile of the strategy. And there are many ways how you can make that work. And when we talk about scaling out, it works the same, just in reverse. So we have our first initial entry. Let's say we get in here on the break and retest. Let's assume we trade the reversal. So we get in long here on the retest or pullback. And then what we can do is, if we don't want to ride our trend for a long time and always have the unrealized profits there, we can decide to book profits along the way. So we could decide that at the first resistance area, so previous support may turn into resistance, and we could say, okay, we want to close a part of this first entry here. And the reason is that you want to book profits, you want to secure profits. You don't want to risk giving all back if you hold your trade too long, or maybe the trend doesn't unfold and doesn't work as well. So what you want to do is then think about getting out of your position slowly and gradually. So you could say, okay, first support, maybe turning into resistance. I want to get out at least a little bit here. I want to secure some profits, and that could be your first scaling out. Then you could look, for example, at the next resistance. You can see here, we could decide to get out here on the second resistance. And then maybe you have a little bit left running, and then you could go for a wider target. And then the third target could be here, where you then maybe close your full position. And there are obviously many ways how you can do that. For example, you could decide to have maybe 4 lots, a very big position in the beginning. And then at each resistance level, at each target, you're going to scale out 1 lot. Or you could also do, you have a small profit first, so maybe you just scale out a little bit so that you just have some profits realized and that your initial risk is reduced, and then you scale out along the way. There are many different ways how you can decide to design such a strategy. You scale out slowly first, or you scale out big first, and then have a little position running, and you just keep an open-ended target and then hope to catch the big trend. But you don't have to worry, because you already have secured some of the profits because you have exited a little bit. And of course, is it good? Should you scale in? Should you scale out? Or should you just go with the one position and do that? And as always, the answer is not as clear. There's always a pro and con. And we need to look at the pros and cons so that we can make much more educated and better trading decisions. So let's look at it. Scaling in, the idea is that the trader is building a larger trading position slowly as the trade idea is unfolding. So as I said, you have maybe your first small position, you're trying to capture a large trend, and as the trend unfolds, you get a little bit more confident and then you scale into the trend as it unfolds. The benefit is that if there is a big trend, the potential profits that you may realize may be much, much larger because you're adding to the trade, to the initial trade as the trend unfolds. So if the trend keeps going and going, each of your scaling in positions is going to make more and more money compared to if you just have your first initial entry. The con is that most of the time the trends won't be very long. The second, third, and the next entries are quickly going to eat up your profits if the trend turns around. And I have an example for you in a moment where this becomes clear. And it's really it can be a big issue. Scaling out, on the other hand, the idea is that you want to realize profits. So the unrealized profits that you see in your broker when your trade is open, there's always the risk that you can give all back. Even if you try to hit a trend, the trend unfolds nicely, but then you're maybe too greedy or your target is just not reached and the market turns around and you're left with nothing or maybe just a small profit. If you would have scaled out along the way, you would have already secured some profits. So that's the idea. You just want to secure some of the profits. The benefit is that, your unrealized profits, they're not going to vanish completely. However, the con is that you may obviously also reduce your potential reward, because if you scale out along the way, you make potentially less money compared to if you would just let your initial position run and then wait for the ultimate target to hit. So there's also the trade-off here. Let's take a look at what I've just explained in the light of scaling into a position and how it can also be a less than optimal approach. So assuming we have our first initial breakout entry here, right? We have one position we get in here. So when the market is here, we have zero profit. Then as the market moves into your favor, you have a little bit of your profit from the first position, right? You enter here. When the market is here, you have a little bit of more profits. Then you have your second entry on the next breakout, little consolidation breakout you get in here. Again, you have your impulsive move, correction you get in here, and your third entry is here. And then you can see it turns around. But what happens actually here? So first of all, you have your first entry here, right? When the market is at this point, your initial position has maybe 50 points. If from here to here, it's 50 points, you have 50 points of profit. The second position here, the second trade, has zero profit yet because it's just the entry, right? So overall, the first entry has 50, the second has zero yet. So we have 50 points profit, good. Then let's take a look what happens when the market is here. If the market is here, your first position may have 100 points profit. So from here to here, it could be 100 points. Your second trade from here to here has 50 points profit. So totally, you have 150 points profit right now. And because the third entry has just been initiated here, the third trade has zero profits for now. All right, good. So far, so good. But what happens now if the market turns around? Let's assume we are now here, right? So we are back here at the second entry. And at the second entry, let's assume the market turns. Your first trade still has 50 points profit, right? From here to here, it's still 50 points. So the first trade has profits. But the second position where we entered, we are right at the entry. So the second position now has 0 points profit. And the third position from here to here is now sitting in a loss. And you have 50 points negative. So the third position, because you entered so late and the market turned shortly after, is now in a loss. And the loss is eating up all of your profits because the first position has now only a little bit profit left and the second position has nothing. But what is if the market completely turns around? Your first position is now back at the entry and therefore 0 points profit. The second trade from here to here has 50 points negative profit or loss. And the third trade from here to here has 100 points loss. So totally, the first position has nothing anymore. The second has minus 50. The third has minus 100. So minus 150. And the message of this is that if you hit a big trend, the profits accumulate very, very quickly. You can see if the market would have gone further after the third entry, you would have had huge profits very, very quickly. But if the market turns around on you, all of your profits will be gone and vanish very, very quickly. And that's something that you have to take into consideration. So if you have a scaling in approach, you also probably have to think about a way to implement a trailing stop loss so that doesn't happen. That if the market turns around, your profits are not going to be eaten up very quickly. And I will come to that in a moment, what that means for new traders or inexperienced traders especially. So how do we scale in? What are the ways how we can define what are secondary third entries? And when it comes to scaling in, you have two options usually. First, you just have your additional entries based on your regular trading strategy. So you could use general breakout approaches, breakouts out of consolidations. You could use crossovers. Maybe you use a moving average as a crossover signal. So during corrective waves, what happens, as we have seen, moving averages, if you use a cross, they cross back, and then you just wait for the cross back into the trend direction. Or you could have a pullback. You wait for the market to pull back during a corrective wave, and that could be an entry. Or any of the previously discussed entry strategies, you could have that as a way to scale in. Or you can just say, okay, I have my first entry wherever, and then I add a new trade every 5 points, every 10 points, whatever it is. So you could say, okay, my first entry is here, and then I don't care about waves, or I don't care about breakouts. I'm just going to add every 50 points, every 10 points, there's a new entry. And that is what some traders do. That's also a possibility. So we could have, for example, your first initial breakout here. We have a base breakout at the moving average. We are trading around it, so it seems like we have a consolidation. Breakout, you have your impulsive wave. You wait for the pullback, then you look for your second entry. Then the next pullback into the moving average, next entry, next pullback, next entry. And there are so many different ways how you could go about scaling in that it's really up to you. And that's really the beauty, that you have so many options. You could use trend lines, you could use support resistance, round numbers, Fibonacci's, pivots, moving averages, Donchian channels, Ishimoku, and anything else. There's really no limitation to how you can go about it. And the same is true for scaling out. Any of the previously discussed exit approaches can also be used for scaling out, right? So assuming we have our first initial breakout entry down here, so we have our initial breakout, and then you could look left and see, okay, where are the big support and resistance levels? Supports turns into resistance, big level. I want to have my first target here. Maybe get out 50% or maybe 25%. Then the next target, big level here, previous support turns into resistance. We want to have a target here. Then here, it could be your ultimate target, and you could have your final position here. And obviously there's so many ways how you can go about it. You could use trend lines, you could use moving averages, you could even look for round numbers to scale out. And the final question in this light is then, should you scale in or out? And in general, what I've seen, making scaling in and out work with your trading strategy is significantly more complicated than if you would trade with a single entry approach. So if you just have one entry and then write it out, that's much, much easier than having scaling in and out in your strategy, because you have so many more variables in your trading if you do scaling in and out. You have to think about how do you trail your stop loss on secondary, third, and the first position as well. What are the dynamics you want to do here? What is the reward to risk ratio that you're shooting for? How are you going to scale in? You're going to scale in 50% first and then small later. What are the percentages and what does it mean for your risk management? There's so many variables here, and all of this needs to be analyzed. You need to track it, you need to tweak it, so that it's very quickly becoming very complicated. And therefore, I would suggest, if you are a new trader, if you're maybe struggling or inexperienced, I would always recommend don't do scaling out in for the first 6 to 12, maybe 18 months. As long as you're not fully confident with a single entry strategy, then it doesn't make any sense to go for scaling in and out, because if you cannot make a single strategy work, a single entry strategy work, scaling in and out will be just impossible, because it's so much more complicated. But there's definitely a place, especially more advanced traders are more probably going to be more reliant on scaling in and out. When we talk about the turtle traders, we are seeing that they have a way to scaling in and out, but they are all a little bit more experienced, and new traders, I would not recommend it. There's definitely a place, and we may come back to that, but in the beginning, I would recommend don't do that, but really focus on making a single strategy work. And then once you're comfortable, try it out. Give it a try, see how it works, see how it feels, and then you will see, does it make sense to you and do you want to pursue it or not?